Anil Singhvi, Chairman of Icon Investment Advisors, joins us now. Anil, good morning. Thank you for joining us.
Morning.
Anil, suddenly the market is falling less, it is gaining more, it is ignoring the bad news, it is capitalizing on the good news. Do you think we have a new bull market in making?
Well, the screen shows that yes, definitely we have a bull market in making, but my views remain same. I don't think fundamentally things have changed as much as the screens are showing. So maybe it's just a pullback rally for last almost about 4 or 5 weeks what we are seeing. But looking for broader economy and look at the corporate working and corporate earnings, I don't think Nikunj is suggestive of the fact that people are talking about now 7,000 and 7,500 Nifty. I would stick my neck out and say that I think we are heading for a huge correction from here.
So what really could precipitate that correction?
I don't think this is really a sustained bull run. So maybe it's a short covering. People were really looking at shorting Indian market in a long way from September onwards. So it's a covering which has come in and few announcements by the government which have really led this kind of thing. But if you look at fundamental issues like economic growth, you look at the rupee where it is, look at the corporate earnings, you look at the new investments. I think all four are still same. I don't think there is any change in those. Why should your rupee be at 55 plus? It doesn't give any impression to me that we are really heading towards a very good 2013.
But incrementally, if I map all the factors which you've pointed out, earnings, there is a belief that earnings have bottomed down. The uptick may not start, but earnings may not fall more. There is a strong case that Reserve Bank of India will cut rate. There is a strong case that some policy action will kick in. So yes, in the near term, there is no visibility, but from a 12-month perspective, maybe from an 18-month perspective, one can confidently say that things will improve. What could go wrong from here?
Nikunj, you got $25 billion of money, right? And still your rupee is 55. It is showing you something that things are not very well. In fact, it's so reactive when we say that people are importing gold, so gold duty should be increased, and that's where we are one cure for current account deficit. I think that shows to a very large extent bankruptcy of ideas. And that's where my problem is, that today we are really going for very short-term situations and short-term solutions for long-term ills, and which is really not going to help. If you look at fundamentally all factors put together, it does not give you that corporate earnings are also going to be much better and we are bottoming out. I don't buy this that we are bottoming out on corporate earnings. From here on, we will have 20% growth. It doesn't look to me from any sector that there can be a 20% growth in bottom line. Sector, I'm saying. A company specific, yes, there would be some companies who will still post good results. So I'm looking at more at the broader markets. It does not give me that the market is going to get a 20% earning kicker.
So Anil, in terms of earnings, what do you think is going to be the worst performer?
Well, I think the broader economy still is into grip of a slowing down situation. You look at automobile, the sector which was so raved about until 6 months back, and now you have this sector really being beaten up by every situation. And going forward also, I don't think this sector is really going to do well. So automobile is one sector which has really held on to, you looking at the type of weightage we have in index, held on pretty well, but now is not showing the signs of that kind of a strength. So to my mind, automobile is one sector. Second sector is going to be infrastructure. I mean, you look at NHAI, and yesterday's Minister of Environment and Forest saying that I am not responsible for holding on to any of the projects. I think it's a joke. I mean, everyone knows that all environmental approvals have come into a problem for last 3 years. So you can't have economic growth, you can't have industries faring very well when broader economy and the decision making is still at a very, very lukewarm stage.
What about the global environment, Anil? Do you think 2013 will be a year of austerity, or it could be a year of slow and synchronized growth at a time when central bankers are printing money? China is printing money, Japan is printing money, US is printing money, and Europe will only print more money.
Well, I think printing money, as you rightly said, is very fashionable. I think all central bankers are showing one-upmanship on that. I don't know how long can it remain, and how long can it not have inflation. In fact, the productivity gains are now coming to an end, and I think we are going to see a huge inflation coming in. So my concern, Nikunj, is that today we have seen time and again in India that when inflation is high, in India still the inflation is high. It's not, I mean, we can't take a solace in saying, oh, it has come down to 8%. 8% itself is a very high inflation. And if the global growth is on account of printing of the money is going to be inflation-led growth, I think Indian companies will find it even more difficult going forward. I come from a background of cement where I've seen time and again that inflation was a major cause of concern for both for top line growth and margins. So I would not fool myself that all is well with us and earnings are bottoming out and RBI will reduce the rate. Of 25-50 basis point rate reduction is not going to really help in terms of our earnings growth. I don't agree on that.
But what is your expectation from RBI this time, Anil? Does it seem like they're going to move on interest rates given inflation still being so sticky?
I think they're barking at the wrong tree. I don't think it's RBI ill. I think RBI has done a phenomenal job. I'm a great admirer of Reserve Bank of India as an institution and Mr. Subbarao personally on that. I think he's done a phenomenal job. I think we'll have to put our fiscal situation in place, and God forbid we should not have a budget which is again going to be more election oriented, more budget which is going to put money in the pockets of the people without having the supply side, without having investment-led economic growth. So I think we are going to go into again a catch-22 situation that we are going to run into election mode budget and at the same time saying that RBI is not helping the cause. And I think he has said time and again that monetary policy can do only that much, can't cure every ill in the economy.
Anil, you just talked about cement as a pack. How is demand-supply situation looking with cement currently? A couple of these mid-cap cement stocks really flared up well.
Well, as I've said earlier also on your channel that I still remain bullish on cement for two reasons. That A, the supply side of cement, which was really causing a lot of concern, has tapered off. I don't think we are seeing many cement plants coming up. And demand side is picking up, not the way one would have liked it, but definitely it has picked up reasonably well. Why second tier and third tier cement companies are really going up? Because if you see the gap between the valuations on EV per ton, ACC, Ambuja, Ultratech, they all are almost at $180 to $200. Replacement cost of a cement plant is about $125, $130. So all those mid-cap stock and small-cap stocks which are trading at $40, $50, $60 obviously have a lot of catch-up to do. And that's where we are seeing this kind of a run coming in.
So will we continue to see outperformance from mid-cap cement?
Definitely, because they deserve to be. In fact, many stocks which are of a good company, good quality, may not be size be their friend, but definitely at 8-10 million tons, if you have a cement company, $60, if it's trading at $60, I think it has a lot of catch-up to do.
Which is one cement company which is available at $60? I cannot think of a single one.
I can give you two.
Okay, why don't you tell me then?
One is your surname itself, it's a Dalmia Cement.
Just a coincidence, let me assure you.
And second one is Orissa Cement. Actually, if you look at these are two very wonderful plays, and they are still at around $60. So
but they have too much of
all
debt,
in your family, Nikunj.
Just a coincidence, like I said. I can go on record and say just a coincidence. But the debt in Orissa Cement and Dalmia Cement is extremely high. Does that bother you?
No, I'm looking at EV per ton, so that is captured in that. So I'm not looking for the market cap, that they are very cheap on market cap. That has to be taken into consideration. But if you're looking at that good management, good size, and they're still trading at around $50, $60, they have a lot of catch up to do this. Even Orient Cement actually may not be management as good or as efficient as Dalmia, but definitely once it is getting bifurcated from paper and cement, I think Orient Cement also will do well.
So besides cement, Anil, where do you see value right now?
It's a very tough call, but I would put my bets onto mid-cap IT companies. I think the larger cap IT companies have had very good for last 10, 12 years. It's now the mid-cap who have done really very well. It's like a Mindtree or a Hexaware or a Mastech. I think they all are going to do very well. And mind you, I'm still looking at it that rupee will remain under a lot of stress next 12 to 18 months. So I would not be surprised if in the forward, if they book their dollars at around 60 odd rupees, I think they're going to have huge upside onto their margins.
What about Infosys, Anil? You come from that era where you believe that Infosys could do no wrong. But unfortunately, the sad fact is that Infosys in last 8 quarters has disappointed. Do you think the current downturn in Infosys is a good buying time for long-term investors?
I think the story of Infosys in terms of what it was as a play, as a one-stop play in Indian IT scenario, I think it has vacated that pole position, unfortunately, for a variety of reasons, and which is some of it's all known and well documented on that. So I don't think Infosys is really a play which you can again see that it can give you a return of 25-30% IRR for next couple of years. In fact, to my mind, if I look at the three biggies, TCS is a far better bet than Infosys and Wipro. So I would always put my money behind TCS if I have to choose a large IT play. But I would rather look at mid-cap IT plays, product companies which are doing far superior job than the biggies.
So which ones do you like out of the mid-cap IT pack?
As I told you, I like Mindtree, I like Hexaware, I like Mastech. I think they are very wonderfully managed and good companies. And finally, there will be an asset play as well. Let me tell you one more thing, that Infosys and Wipro will not be sold out. But even a Hexaware or a Mindtree or a Mastech, they will be finally get gobbled up by some large players. So you have both. You have earning upside coming in as well as the asset play.
Anil, you know it better than me, but markets, they always follow cycles. Sometimes you have bull market cycles, sometimes you have bear market cycles. In last 4 years, we've been in this trading cycle. When do you think Indian markets will convincingly snap out of this 4-year range?
Because I think I will again stick my neck out and say that next 18 months are going to be very difficult for us, because India, we can't decouple ourselves and say that economy will do well despite all political rumblings. I think we will again be seeing a lot of political rumbling in next 18 months because elections are there. There are a lot of views and a lot of reviews and a lot of things which are going to play around on that. So it's going to be a tough time. So I think 18-month period we will still be in a range situation. We will not really get out of it. We have seen a rally in last 6 months or whole of 2012 if I look at and document that. But going forward, I think next 18 months are going to be very challenging for us.
Now for the year 2012, more than earnings, P's have expanded. There was global liquidity, China, Brazil and Russia, they took a knock, and all that money clearly got channelized to a market like India. For this year, since global liquidity is abundant, do you think more than earning expansion, we could see a P expansion?
I personally don't think that we can attract $25 billion in 2013. I think post July, August, I think we will get into a scenario of reviewing our political equations, and all that will come in play. And in that uncertain time, my take is that it will be difficult for fund managers to really look at India in a big mindset and saying that, oh, here I'm going to invest it for next 2 or 3 years call. Because everyone would like to see what the results are going to be. They are going to be most uncertain times in terms of which party, what coalition will come in play. So I think it's going to be, till June we may still see some money coming in, but thereafter it's going to be a very difficult call. So my take is that we may not see that kind of money coming in. So it will not be a liquidity driven market. It will be again going back to the fundamentals, and core of the issue will be political equations.
And then one another space wherein stocks have been making new highs on a daily basis, pharma. Is there anything that you like out of that pack?
Well, I don't track pharma so much on that, so I wouldn't stick my neck out on that. But definitely pharma has, as a play, I think still India has a lot of advantage in terms of what our pharma companies are doing. So going forward, this could be one, but it's again driven by a lot of policy parameters within the country and globally as well on that. So every time you will have some policy framework which will be coming into their earnings model or into their growth model. So one has to see how we do away with our whole pharma sector policy framework and global situation where our pharma companies really compete on. But given that, I think we still have a lot of strength in our pharma industry per se. I feel that.
Anil, just when I think that bears are extinct on Dalal Street, I end up meeting you. Okay, good to have you back on ET Now, and thank you for flagging off some key concerns which long-term investors they should not ignore.
Thank you very much for having me.